Guys, welcome back to XRP Insider Network, where we connect the dots between global macro moves and what it means for your XRP before the mainstream catches on. Let's get into it. Let me start with a question nobody in mainstream finance is asking right now. If XRP is just a speculative altcoin, why are the most powerful financial institutions on Earth quietly rebuilding their entire infrastructure around the technology that powers it? That's not a rhetorical question. That's the thread we're going to pull today, and by the end of this video, you're going to understand something that the overwhelming majority of retail investors, including a lot of people who call themselves crypto experts, are completely blind to right now. Here's what you clicked for. XRP has been mispriced. Not slightly. Not by a margin you'd expect in a volatile market. Mispriced in a way that historically only happens once or twice in a generation, at the exact moment when an asset is transitioning from one category of investment to an entirely different one. And here's your bonus angle. The very mechanism that mainstream media is calling bearish for crypto right now is actually the filter that's going to make XRP holders extraordinarily wealthy. Stay with me on that because I'm going to prove it. Let's talk about the world most people think we're living in right now. The common belief, the one you'll hear on every financial talk show and in every Reddit thread, goes something like this. Crypto is still a Wild West. Institutions are cautious. Regulation is murky. Smart money is sitting on the sidelines waiting for certainty before they commit real capital. If you believe that narrative, selling or sitting on the fence right now makes complete sense. The problem is that narrative is about 6 months behind reality. And in markets, being 6 months behind reality is the difference between building generational wealth and watching someone else do it. Here's the contrarian take that this channel has been built on. We are not in a period of institutional hesitation. We are in a period of institutional construction. There is a massive difference between those two things. Hesitation means they're watching. Construction means they're building. And what they're building right now is the architecture that will make it impossible for XRP to remain at its current valuation once the doors open to the general public. The proof is not theoretical. It's not a prediction. It's documented, institutional, on-the-record activity happening right now. Franklin Templeton did not dip a toe into crypto. They acquired CoinFund entirely, absorbed all of its liquid cryptocurrency strategies, hired seasoned industry veterans, and created a dedicated institutional grade division called Franklin Crypto. But here's the detail that most coverage completely missed. The M&A transaction itself was executed using tokenized securities on-chain. Read that again. A multi-trillion-dollar traditional asset manager did not just invest in blockchain. They used blockchain to conduct their own corporate deal. That is not experimentation. That is adoption. That is an institution saying out loud with their balance sheet that this infrastructure is ready for prime time. And it doesn't stop there. The New York Stock Exchange received SEC approval to list options on multi-crypto commodity trusts without requiring separate product-by-product filings. What that means in plain language is that the regulatory architecture surrounding crypto is now being standardized to match the same frameworks used for oil, gold, and agricultural commodities. When a pension fund wants to hedge a gold position, they use a standardized commodity options framework. Now they can do the exact same thing with crypto. The psychological and structural barrier that kept institutional capital on the sidelines just got significantly lower. Now here's where it gets really interesting, and this is the part that I think is most misunderstood right now. You've probably seen the narrative that prediction markets are pulling speculative capital away from altcoins, and the mainstream take is that this is bearish for crypto broadly. I want to flip that completely on its head. What prediction markets are actually doing is performing a kind of natural selection on the entire crypto ecosystem. Projects with no utility, no institutional relationships, no sustainable business model, they're being starved of the speculative fuel that kept them alive. And that's a good thing. Not for holders of those projects, obviously, but for every serious XRP holder in this audience, it is an extraordinary development, because when speculative capital leaves the system, what remains is utility-driven demand. And XRP has utility that is not theoretical. It is operational, it is expanding, and it is being built into the plumbing of the global financial system right now. Let me bring in a perspective that most people slept on. Mike Kalish at the CFTC gave a statement about his first 100 days in his role that deserves more attention than it received. He talked about expanding access to risk management tools, rolling back regulations that were outdated, and delivering on the goal of making America the dominant force in digital asset infrastructure. But the most revealing part of what he said was about his prior career. He spent years on the other side, defending legitimate crypto builders against what he described as regulatory persecution, watching real companies with real technology get forced offshore to the Cayman Islands, spending enormous resources on legal structures just to survive. Now he's inside the regulatory apparatus with the explicit goal of creating safe harbors for those same builders to come back home. That psychological and institutional shift from crypto is guilty until proven innocent to come build here, we want to understand what you're creating. That shift cannot be overstated when you're thinking about the long-term trajectory of XRP specifically. Because Ripple spent years being exactly the kind of company that was targeted, and now the regulatory environment is structurally inverting. Paul Atkins at the SEC is standing up crypto task forces designed not just to evaluate digital assets, but to educate the regulators themselves and build purpose-fit rules. This is not tolerance. This is active institutional encouragement from the people who control the gates. Now let's talk about XRP directly, because this is where the mispricing becomes most visible and most urgent for this audience. The mainstream market is still pricing XRP as though it were a speculative altcoin in a crowded field competing for retail attention. The fundamental reality is that XRP is transitioning into something categorically different: settlement infrastructure for the global banking system. Those are not the same type of asset. They don't get valued the same way. They don't attract the same type of capital. And the gap between how XRP is currently priced and how settlement infrastructure gets priced once institutional adoption reaches critical mass, that gap is where your opportunity lives. Think about it this way. The regulatory outcome from the SEC case created something that almost no other crypto asset in the world can claim: a documented legal precedent establishing XRP as not a security in secondary market transactions. Other projects would spend hundreds of millions of dollars and years of legal battles to get that kind of clarity. XRP already has it, and yet the price still reflects the hangover from years of legal uncertainty rather than the forward value of an asset with a clean regulatory runway. That is the definition of mispricing. The market is still reading yesterday's newspaper. The Clarity Act is advancing through Congress. Fannie Mae is exploring blockchain integration. MasterCard is building crypto-native payment infrastructure. These are not crypto companies making crypto announcements to get attention from retail investors. These are the foundational pillars of the traditional financial system publicly committing to a crypto-native future. And every single one of those institutions needs a bridge asset, something that moves value across borders, across currencies, and across legacy systems with speed and finality. That is the exact problem XRP and the XRP ledger were architected to solve. Here's what I need you to really sit with, because this is the section where the dots connect in a way that most people never get to. We're not watching crypto get added to the traditional financial system like a new product line. We're watching the traditional financial system migrate to crypto rails. Franklin Templeton executing an M&A deal on-chain is not them adding crypto to their business. It is them running their business on blockchain infrastructure. That is a fundamentally different statement. When the NYSE builds commodity trust frameworks that treat Bitcoin and Ethereum the way they treat oil and wheat, they're not welcoming crypto into their house. They're acknowledging that crypto infrastructure is the future of how assets will be managed. XRP is not trying to earn a seat at that table. Ripple built part of the table. Let me give you the macro framing that ties all of this together. Traditional investment returns are under serious pressure right now. Private credit markets are struggling. Equity volatility is brutal. Even gold and silver, the classic safe haven trade, have been rough for a lot of investors. Meanwhile, Bitcoin held relatively steady through the worst Q1 it had seen in 8 years, and institutional infrastructure was being built around it the entire time. That is not what a dying speculative asset looks like. That is what an asset looks like when it is transitioning from one investor category to another, when smart money is accumulating quietly during maximum retail pessimism, which is exactly when these kinds of opportunities exist. The mathematical reality of what happens when institutional capital starts flowing into a market the size of crypto is something most people haven't truly internalized. Global institutional capital manages assets worth hundreds of trillions of dollars. A 1% allocation shift, not 5%, not 10, 1%, into crypto assets from that base represents capital inflows that dwarf the current total market cap of the entire crypto ecosystem. For assets that sit at the intersection of regulatory clarity, institutional utility, and established infrastructure, and XRP hits all three. That kind of capital concentration doesn't produce gradual price appreciation. It produces step function revaluations that happen faster than retail investors can react to. And that brings us to the most important insight I can leave you with today, because this is the part where understanding the structure of what's happening protects you from the most common and most costly mistake XRP holders make. These institutional adoption thresholds do not get crossed gradually. They get crossed in discrete jumps. The Clarity Act passing is not a slow upward slope in institutional interest. It's a trigger. Additional ETF approvals are not a gentle tailwind. They're catalysts that unlock entire categories of capital that are currently locked out by mandate. Payment integration by a company like MasterCard is not a press release. It's a utility demand signal that fundamentally changes how XRP gets priced in institutional models. Each of these individually would be a significant market event. The fact that multiple of these thresholds are approaching simultaneously in a regulatory environment that has shifted from hostile to actively encouraging is what makes this moment different from every other moment this audience has lived through in their time holding XRP. The mistake people make is waiting for confirmation before they position. But confirmation means the opportunity has already repriced. The institutions don't position after the catalysts become obvious. They position during the period when retail investors are debating whether it's worth $1 or 50 cents. That's where we are right now, and the institutions are not debating. So here's what the picture looks like when you step all the way back and see it whole. The largest asset managers in the world are building dedicated crypto infrastructure. The regulatory agencies that spent years treating crypto as a threat are now staffed by people who spent years defending crypto builders. The legislative frameworks that will unlock institutional mandates are moving through Congress. The traditional financial system is not adapting to accommodate crypto. It is migrating onto crypto rails. And sitting at the center of the global cross-border payment layer that all of this institutional infrastructure requires is the asset that this community has had the conviction to hold through years of uncertainty and noise. The gold bars are still on the highway. The retail crowd is either too distracted or too discouraged to pick them up. But if you watch where the trucks are positioning, Franklin Templeton, the NYSE, the CFTC, the SEC, MasterCard, Fannie Mae, they are not pointed at the exit. They are pointed at exactly the infrastructure Ripple has been building toward since the beginning. That's not a coincidence. That's the home run strategy playing out in real time. You already made the hardest decision. You held when it wasn't popular, when the lawsuits were loud and the FUD was everywhere. The period you're entering now is not the hard part. The hard part was surviving the construction phase. What's coming is the validation phase. Stay patient, stay positioned, and do not let short-term volatility shake you out of a long-term structural revaluation that most of the investing world still cannot see. The signal is clear. The institutions are moving, and you are on the right side of this before the mainstream catches on. Mike out.